Hey everybody, and welcome to chapter 11. And in this chapter, we're going to be continuing our conversation on financial institutions. Specifically, now that in chapter 10 we talked about commercial banks, we're going to move on to one of my favorite topics, which are non-bank financial institutions. And we're going to get things started with this chapter by looking at specifically investment banks. So we're going to talk about what they are and what they do, how they finance themselves, and then we're going to add a little bit of a discussion on what's happened to them since the 2007 recession. So, investment banks primarily do six different things, and we're going to talk about each one in this video. So, first, they provide advice on issuing new securities. Second, they underwrite new securities. Third, they provide advice and financing for mergers and acquisitions of companies. Fourth, they participate in some financial engineering like risk management. Fifth, they do a lot of market research. And sixth, they actually go in and do some proprietary trading and market banking. And while the first three have really been used for a long time, the last three have really only developed in the last couple of decades. So first, when we look at why it's important for them to provide advice on new security issues, companies from Coca-Cola all the way down to small private firms, they really don't know how to handle themselves in the market. Like Uber recently went public, and Uber is, they're great with their app in their construction of a company. However, they don't really understand the market. So it's hard for them to figure out at what price they should value themselves at and how they should enter into the market. And so publicly traded companies, because of that, they need some help. And that's where they hire investment banks to act as consultants to help guide their way and hold their hand in the stock market. Additionally, it doesn't just stop there because commercial companies are always issuing and buying back stock on the market, and it's usually investment banks that recommend these sort of operations. Additionally, beyond just the advice that they give on new security issues, they will also underwrite it, especially when dealing with IPOs. For these companies going public for the first time, it's very risky. If they value their price too high, then the stock market is just going to crush their price and their market value. However, if they set their price too low, they're not going to get nearly as much cash that they could from the market. Additionally, timing is really important with IPOs. So, because of that, it's really hard to do, and what a lot of these private companies will do is they'll hire investment banks to underwrite the IPO. And there's basically an exchange where the investment bank will handle the entire IPO process. In exchange, they'll guarantee a certain market value stock price to the company that is going public. That means that any stock value or profit that is gained above what the stock market sells for is pocketed as profit for the investment bank, while the company going public will get some set return from the IPO. And the same thing works even with new bond issuance. A lot of times, investment banks will actually be the ones issuing the bonds on the behalf of another company, and then they will get the profit as well as pay off a set amount to the private company. And so, investment banks really need to, they add this valuable service to public companies. Now, looking at providing advice and financing for mergers and acquisitions, this kind of goes in the same flavor, where they can get hired as a consultant to match a potential buyer and a seller to first off conduct the sale as well as to find an appropriate market value for a company that is going to get bought. And it's really hard to price companies accurately, especially when they're private firms, because they don't have to give SEC information like 10Ks or 8Ks. So that means things like material information to the price of the company are not public. So these investment banks have become experts at valuing what we call private equity, so that in these mergers and acquisitions, the both the buyer and the seller get a fair deal. There should be some premium for the potential seller because otherwise it wouldn't be worthwhile for them to sell the company, as well as there has to be tangible profit through the future growth of the company seen by the buyer. And these happen all the time. You think of, like, for example, Amazon buying, pretty much everything from Ring to Whole Foods. Amazon is trying to diversify itself, but Ring was a private company, and so they had to hire an investment bank to conduct the sale and link everything together. And investment banks, when they do enter into these mergers and acquisitions, they're going to receive their revenue through commissions rather than the price of the sale. So they actually do a really good job of finding fair market deals. Now, financial engineering, we're going to get into a little bit of a more convoluted realm of modern investment banking. And this one I think might be of particular interest to a lot of you because financial engineering just means the development of new financial securities or strategies. And those in investment banks that do these are called quants. And these quants are some of the most bright mathematical minds in not only the finance industry but the world because it takes a lot of understanding to come up with these new very sophisticated trading strategies or to create these new securities. For example, credit default swaps, they didn't exist until the early 2000s, and it was the quants that had to first price the security accurately as well as provide viable strategies to investment banks to either make a profit or to even sell these CDSs. And because of the requirements associated with financial engineering, uh, you are always looking at some sort of post-grad degrees in either math, economics, or finance, or even computer science now. So these are all masters or PhDs with a big emphasis recently on PhDs. Additionally, all these quants have a very deep, sophisticated understanding of just raw, pure coding languages such as C++, Python, and MATLAB. Additionally, they all have, strong business acumen and financial acumen, so they understand the ins and outs of platforms such as Bloomberg and Excel. So, if any of you are interested in financial engineering, just know that you're in for a long haul of learning, especially in math and computer science. However, the downside of financial engineering is because the people are so smart that are making these securities and strategies, it makes it really hard for others to understand what they're even looking at because intellectually we're just looking at a different realm of space, which means that like regulators don't even understand what they're looking at when they are presented with a new type of security. And so that means that nobody really understands the risk associated with some of these strategies as well. Well, next is research, and this one's a little bit more basic, but nonetheless interesting. It's only been in the last few decades that these analysts that have always worked at investment banks have switched from just acting in this advisory role to just doing research for the sake of research. And when they do this research, it is beneficial to the firm and their potential clients, but they also have just started to sell their research. Some of it usually goes public, or they have partnerships with different trading platforms where they'll assign ratings such as buy, hold, or sell stock based on their research. Now, what they'll do is become an expert in a specific firm or an industry and just every single day read reports coming in about, the sector, the industry, macroeconomics, things like that, and then they'll present their findings. And when you look at potential trading platforms to trade on, such as like TD Ameritrade, TD Ameritrade has agreements with some of their research analysts and as well as other financial researchers to make all this research public to their clients. Now, last and finally is the one that we all traditionally think about investment banks doing, which is proprietary trading, even though it only started fairly recently. Now, what I mean by proprietary trading is just using the bank's personal account to enter into the market rather than doing so for a client. And the problem with this is that it really exposes banks to risk, including funding risk, which is a fourth type of risk that we really haven't talked about too much in this class yet. And that's just the risk that short-term borrowing and long-term investments dry up. Because these investment banks, they are typically entering into long-term contracts. That is what really sets these investment banks apart from, like day traders, is the sophistication of these long-term, like derivatives that we talked about in the last chapter. And with that, they also buy a lot of these or contracts or enter into these contracts using short-term loans. They never take out like a 30-year fixed loan to buy an MBS. Rather, they use, like over-the-counter trades or repos, etc., to finance the trade. And so this proprietary trading means that their assets are way greater than the cash that they have on hand. So they take out a lot of debt, but the debt expires very quickly. So if they don't get more debt to keep entering into the market to do this proprietary trading, then they have huge funding risk. And we're going to talk more about that with repo financing specifically. And first, there's two main types of financing for banks. The first type is retail funding, which just uses deposits to finance investments. So this is what we think about with like commercial banks, where you deposit your money and then the commercial bank uses those deposits to make investments. But additionally, there's wholesale funding, which is what we're talking about with investment banks and funding risk. And wholesale funding is just short-term borrowing from other financial firms. Notice two things. First, that means that we're looking at short-term durations, we're thinking like overnight or short-term, as well as we're just looking at other financial firms. They don't have private depositors. And the main way that they enter into wholesale funding is through the repo market. And the repo market allows for the security in the agreement to be posted as collateral if the firm goes under while using the financing to buy an asset. So a lot of people in these banks will tell you that the repo market is safe. However, it first faces a maturity mismatch because of the difference in the maturity of the liability, in this case the repo, compared to the asset, such as a long-term swap. Additionally, lenders who engage in repo financing have no federal guarantees, unlike retail funding. We're going to get more into that later on in this chapter, but that means that this market is basically being done on the like privately. And so that means A, that interest rates can float heavily, and then B, that there can be significant damage and losses even when collateral is posted. Because, for example, think about uh, with the housing crisis, when MBSs are what's being put up as collateral to finance the debt, uh, the MBS is worthless. And so these investment banks, like for example, Lehman Brothers, that were posting MBSs for collateral, Lehman Brothers went under, but the MBS that they posted was also worthless. And so there was actually a lot more risk associated with the repo financing and issuing the debt on the repo market than a lot of investment banks realized. Additionally, uh, beyond just like problems with the underlying assets, there are a lot of problems and worries about interest rate risk being greater in this market, in the repo market, compared to like in retail funding or commercial paper markets. So, for example, and this went really just unnoticed in larger markets and in the news, in September of 2019, the overnight repo rate actually went from 2% to 9% in one day, which meant that companies that were entering into a repo contract overnight, they had to pay 7% more interest on the repo market. And there's a lot of details that went into why it did so, but it was weird because there was nothing fundamentally incorrect about the economy. And that was kind of an alarm bell for a lot of financial regulators, and in part the Fed, because that showed the interest rate risk in the repo market, which was completely unregulated, So the Fed could do very little to stabilize the interest rates. And to handle the repo crisis, the Fed actually put in $250 billion at the repo market to try and flood the market with lower interest rate repos to try and bring those interest rates back down. And did so successfully, which is why we didn't really hear more about it. But this, as I mentioned, was an alarm bell. So there are proposals to establish a Fed-backed standing repo facility to engage in repos. And the main reason for this is to control for interest rate risk, but additionally to make sure that the repo market doesn't dry up like it did in 2019. So now we've talked a lot about banks and the risks that they have. We now need to talk about like modern investment banks because we've referred to a lot about the financial crisis, and specifically we've alluded to investment banks having all sorts of problems because their assets were worthless and the market liquidity dried up. So these companies came crashing down back to earth and were considered completely worthless. And what ended up actually happening was every single standalone investment bank went through some massive changes. So, for example, Bear Stearns was bought by J.P. Morgan Chase. Merrill Lynch was bought by Bank of America. Goldman Sachs and Morgan Stanley became financial holding companies regulated by the Fed. So they became a fundamentally different structure and had a little bit more federal oversight. And as you know, Lehman Brothers just completely failed. But even though they're no longer these classic standalone investment banks. A lot of their operations remain the same. So that means that the lessons and the problems associated with the financial collapse are still valid today, even though they have these different structures. Even Bear Stearns and Merrill Lynch, which are now attached to companies that have commercial banking components.